This video covers the causes and events of the Great Recession and the Dodd-Frank Regulatory Act that followed. I've been explaining the Great Recession for over 10 years in the classroom, and it's rather difficult. It's difficult for three reasons. One is there was a lot of things going on at the same time in the economy. That's what I mean by simultaneity. It's hard to break into those loops that were going on, those interactions that were all happening at the same time. And what do I mean by that? Well, we can see during the Great Recession and preceding the Great Recession is that the financial markets and the real estate markets became very much entangled. So you have banks, shadow banks, securitization, mortgage-backed securities, the commercial paper market, and the credit default swap market growing at tremendous rates at that time. And all of these factors play into the Great Recession. Before we discuss the Great Recession, let's actually look at what happened right before the meltdown. What was the economy doing? What was the Fed doing before the Great Recession? And what did real estate prices look like before then? Let's look at this graph here. Here is the effective Fed funds rate. We'll have a lot to say about the Fed funds market and the interest rate that comes out of that market later on in this course. It's one of the primary tools that the Fed uses to try to manage the economy. So let's back up a second and make sure we're on the same page with respect to what the Fed funds market represents. Recall that banks are required to hold a certain amount of reserves. They are required to hold about 10% of all their deposits in reserves, meaning cash in the bank or at the Federal Reserve. Think of it for now as just being literally cash in the vault. For every dollar that's been deposited, 10 cents has to be in the vault. Well, banks have to meet reserve requirements periodically. They're calculated every couple of weeks or so. And banks that are short need to borrow. And banks that have excess funds can lend them out and earn some interest. That's a perfect example of a need for a market. There's the demand for reserves for banks that are short on their meeting their reserve requirements. And there's banks that have supply because they have excess reserves. For some reason, they have excess cash. Supply and demand meets up. And the price of those funds is called the Fed funds interest rates. That's what we're dealing with, the actual federal funds market interest rate. If you look at the blue line from the early 1980s all the way to 2020, you see that there's basically a downward trend. And the Great Recession is that wide shaded gray bar in 2008, 2009 in this picture here. So you see the long trend, the downward trend in interest rates. To people in finance, that means that there was a strong bull market in the bond market for years, decades actually, as interest rates came down. And so in the red line here, you see real estate prices, and you see the trend in real estate prices denoted by this black arrow here. And you see an upward trend, and then you see what I will refer to as a bubble in the real estate market happening before the Great Recession. And what's a bubble? Well, think of it as, in this case, real estate prices growing at a rate faster than fundamentals. And what do I mean by fundamentals? Well, think of this upward sloping line as reflecting growth in personal income, reflecting interest rates in the economy, reflecting population and employment growth. That's what I mean by fundamentals. And so those fundamentals were growing at a certain rate. Just assume that, imagine it's being reflected in this trend line. And then you got real estate prices growing significantly faster than that trend line. That's basically what we refer to as a bubble. The same thing happens in the stock market. So what are fundamentals in the stock market? Sales growth, net income growth, cash flow, ultimately cash flow growth. And if stock prices grow faster than the underlying growth of fundamentals, say cash flow of the company, then you could probably have a stock market bubble if it grows for a significant amount of time above that trend line in fundamentals. So we see the bubble in the real estate market here preceding that wide gray bar, the Great Recession. So let's get back to the blue line. The blue line is the Fed funds rate. You can see it came down dramatically. That's in part because the inflation rate in the country has come down dramatically over the past several decades. Now, let's back up to right before the Great Recession. So here's what's controversial amongst economists and people who study the markets. The question is, what caused this Great Recession here, this shaded area? Well, that's what this whole video is about. But a lot of people point to the Federal Reserve as causing it, ultimately causing it. And so here's what happened. In 2005-ish, the Federal Reserve saw that the economy was growing very strongly and was worried about inflation picking up and started to raise interest rates. There's the interest rates that it's increasing. Well, when interest rates rise, it tends to slow the economy. That's the point. It slows the economy to reduce inflation. We have a lot to say about that. So take it for granted for now that that's what happens if you don't fully understand it. But by the end of this course, you will understand it because it's an integral part of the last end of this course. So the Fed raised interest rates to slow the economy. You know, if interest rates go up, it becomes more costly to borrow. Mortgages become more expensive, which means your house price becomes more expensive. And that kind of slows the real estate market, and the entire economy slows down because manufacturing firms and other companies tend to slow down on their borrowing, and companies borrow to expand their business. That's the assumption. So you can see when interest rates started to rise, there was a drop in the real estate market. And so this is the real estate market for the entire country. It includes a lot of places that didn't bubble over. So as you know, the real estate market bubbled before this, but it was really taking off in certain markets like Las Vegas, Florida, California, and a lot of the Midwest barely saw a bubble in the real estate market. But in any case, you see this drop off, interest rates go up, and people say, well, okay, it's that increase of the interest rate that's causing this Great Recession and this drop in real estate prices. But some people say they're not so fast. Go back a little bit sooner. Go back to the recession that we had after the dot-com bubble in 2001. So in 2001, we had a mild recession. It's a narrow band here of gray. And notice what happened. The Fed, in order to fight that recession from the dot-com bubble, that was a stock market bubble that popped. And when stock market bubbles pop and also real estate market bubbles pop, it tends to cause recessions. And we'll talk about how that works. It's a lot of deleveraging that happens in the economy. But in any case, when the stock market bubble popped, it caused a recession. And then it was compounded by the fact that we had 9/11. And when all that happened, the Fed dropped interest rates dramatically to pull the economy out of that recession. Some people view it as a drop in interest rates that went way too far. So notice the big drop. I mean, if you look at the preceding period when the Fed dropped interest rates in the early 1990s, it dropped them down, this Fed funds rate, to about 3%. Here, it's dropping them all the way down to about 1%. So some people view this dip right here as being excessive. And that excessive drop in interest rates spurred the real estate market bubble that followed later on. It doesn't happen immediately. It takes a little bit of a lag here for that bubble to grow. But bubbles can pop pretty quickly. So let's continue here. So we see a downward trend in interest rates for the Fed funds rate. And then we see the ZLB, the zero lower bound, which we'll talk about later in this course. Interest rates basically hit zero, stayed at zero for a while until the Fed started to get worried about the possibility of inflation, started to raise interest rates, and was on its way back to trying to get the Fed's balance sheet and the economy back to normal with normal interest rates. And then coronavirus hit. The Fed dropped interest rates to try to spur the economy, and we're right back to another zero lower bound. So that's some background preceding the Great Recession. I'll have more to say about it, though. Let's continue. Causes of the real estate boom. There's many of them, as I said, because there's a lot of things going on at the same time. So we had low interest rates right before the Great Recession. There was a huge amount of liquidity in the financial markets. And those two things coincide. The Fed lowered interest rates. How does it lower interest rates? Well, it ended up putting more money in the economy by buying securities. We'll have a lot to say about that. It's a little early to get into that at this point. But keep in mind that in order for the Fed to lower interest rates, which is the price of money, it has to supply a lot of money. And if it supplies a lot of money, supply increases, prices drop, and interest rates are the price of money. So there was a lot of liquidity in the financial markets as the Fed flooded the economy with cash, basically. There was also a lot of excessive leverage going on. Lots of firms were borrowing, and they're borrowing and taking on excessive leverage because they're very optimistic about what the economy is going to do. You don't leverage yourself up thinking there's a recession coming. So people became very optimistic about the economy, and that's when excessive leverage takes place. And then also there was an increase in the supply and demand for mortgage-backed securities that took place, and we'll describe that in this video. There was also widespread acceptance of alternative financing methods, a nice way of talking about ninja loans and ARMs. So what was going on in the financial markets is there was a big push to do subprime lending. And subprime lending is lending to individuals with low credit ratings. And so ninja loans are loans. So this is a term that was created during the Great Recession. Ninja loans means no income, no job, and no assets, yet people still got loans, mortgage loans. That was a concern. That was lending gone awry. And then we had adjustable rate mortgages, which have been around for a very long time, but they really took off in the subprime lending area, as we'll talk about as we get through this video. There was substantial speculation going on in the real estate market. There was a lot of flipping. People were buying real estate at one price and then selling it a year later at a much higher price. And then there was a lot of non-bank mortgage lending, which that non-bank mortgage lending is basically shadow banks. So as a little more background to what was going on in the financial markets, a lot of financial institutions and companies had lots of cash on their books. Like I said, they were flush with liquidity, and that came basically from the Federal Reserve, supported that liquidity, developed that liquidity. So the Federal Reserve helped bring that liquidity into the economy. Then the stock and bond markets were very, very stable. There was very low volatility in the stock market. And that's a good thing. When the stock market's very stable and it's growing, people look at that as very positive. The uncertainty is less in the economy. And that was a good thing. Then tying in with that is credit spreads were non-existent. What I mean by credit spread is it's the interest rate on a risky loan or a risky bond less the interest rate on a risk-free loan or a risk-free bond. And then that spread, that difference in interest rates, reflects a risk premium. We call them credit spreads for credit risk that the company will go bankrupt. The company that's borrowing the money through a loan or a bond would go bankrupt. Well, those credit spreads were non-existent. Well, where do credit spreads come from? Well, people. People at that time were not very risk adverse. They thought the economy would continue to grow forever and stay strong. And so they weren't nervous and worried about an upcoming recession. So let's look at the stock market here through this time period. So there you see at the very beginning of this graph, you see the stock market dropping 40% coming off the dot-com bubble. That's 40% evaporation of stock market wealth. That's trillions of dollars wealth evaporating that people just don't have. So it tends to cause a recession when that occurs. Now, look what happens. 2002 to 2007, we see a 133% gain in the stock market. And notice the stock market's going up, nice and stable increase. It's not highly jagged. There's always going to be a few jags in there, but it's not very jagged. And that's the tranquility that I was talking about. Then you can see the Great Recession hitting and the stock market crashing 55%, which is huge. Imagine people's retirement dropping, the money they've saved for retirement dropping 55%. And then after that, we went on to a very long bull market, all the way up to the coronavirus. In the years leading up to the summer of 2007, right up to the Great Recession, the real estate market grew extraordinarily dependent on cash from the financial markets. And that happened through securitization and commercial paper, which I'm going to explain a little later on. And if you watch some of these videos in this course, you've probably hit this material before, but I'm going to cover it again. In fact, you've probably heard bits and pieces of the Great Recession in this course, but you haven't had it all tied together. This video is about tying the whole picture together and tying the whole story together for you. So basically what I'm saying is the real estate market was dependent on the financial markets. And really what happened was the financial markets became dependent on the real estate market. They were entangled. And investors were kind of happy to buy real estate indirectly through mortgage-backed securities. So there was great demand for mortgage-backed securities, and there was great supply for it also. So during the several years before the boom, real estate market practices, the lending practices, became very lax, especially among non-bank lenders or shadow bank lenders. Prudent lending practices such as the use of reasonable down payments, reasonable collateral to loan values, reasonable payment to income ratios were ignored. Another thing that was going on at the same time is that a lot of loans were originated as adjustable rate mortgages. As I said earlier, adjustable rate mortgages have been around a long time, but they were extremely popular to lending in the subprime space. And the reason why they were popular is that adjustable rate mortgages usually have teaser interest rates that are extremely low. And then as soon as interest rates in the economy start to increase, the rate adjusts and goes up, and it could go up dramatically. And if it goes up dramatically, then people don't have enough money to pay off the interest on their mortgages and default on their mortgages. And not only that, when interest rates go up, the economy tends to slow down and unemployment increases. So you got the perfect storm there. You got higher interest rates, you got higher unemployment, and then you're likely to see lots of defaults, especially on subprime lending. So what happened with the subprime lending? Well, mortgage lenders begun tapping into what was considered an underserved market, the subprime market. A lot of lenders before that had stayed away from the subprime market because it was so risky, and they were very cautious about it. But with securitization and mortgage-backed securities, investors could ultimately diversify significantly within the subprime space, in theory, reducing their risks dramatically. But like I said, risk aversion had dropped off dramatically. People were overconfident. So a lot of lenders started moving into the subprime space because they could make a lot of fees off it. So like I said, the volume of adjustable rate mortgages exploded, especially with low teaser rates. And then those rates ultimately increased dramatically when interest rates in the economy increased. Now let's see what happened to non-prime mortgage loan originations. Look at the spike right before the Great Recession. It's dramatic increases. So as I said earlier, around 2004, 2005, a strong economy caused concerns. The Fed was worrying about higher inflation, and the way the Fed cools off inflation is through higher interest rates and slowing the economy, reducing the growth rate in the economy. And like I said, we'll talk about that later on in the course. So what happened was we had higher interest rates, adjustable rate mortgages jumped, and unemployment began to increase, especially for the people with low income. Then what happened was we started to see foreclosures in those areas spike in the subprime area. Now, before you see foreclosures spike, you see loans going past due, meaning the payments are not being made on time, and they become delinquent. Then foreclosure happens. So let's look at that. So here's the delinquency rates for the United States, New England, and New Hampshire through 2009. And basically what you're seeing is that big upward trend starting at around 2006. So a little bit of lag from the time the Fed starts raising interest rates. So the Fed raises interest rates. It does have some impact immediately, but there's often a big part of that impact happens later on. There's a lag. And that's what you're seeing here, the lag. You can see the same thing here in past due rates for subprime loans. And so you can see adjustable rate mortgages are the ones that really spiked the most compared to subprime fixed rates without those teaser rates. Now let's talk about securitization. Securitization is how the real estate market became connected to the financial markets. When I say financial markets, I mean the stock and the bond market. It's through that collateralization of mortgages, securitization, and the use of commercial paper. Let me explain. So let me talk about securitization through this slide for a moment, and then we'll move off the paper and pencil and take a look at mortgage bundlers. And I think you've seen that before. It depends on which videos you've seen in this course earlier, but I did cover mortgage bundlers, but I'll show it to you again to refresh your memory on how mortgage bundlers work, because they're involved in the process of securitization. So it's an important component of this story. And so what financial institutions, both banks and non-banks, pooled mortgages that they had bought from banks or originated in banks, repackaged the cash flows and sold them as bonds. And so those bonds get sold in the financial markets. And so that's how you take real estate, and real estate gets connected to the financial markets through this securitization process. Taking loans that are backed by real estate, in other words, mortgage loans, packaging the cash flows, and then selling those cash flows as bonds that are sold in the bond market. And there you have the connection. Let me show you graphically. So here we have a bank with mortgages, let's say of $100 on its books. Now these mortgages could last decades on the books, and the bank would have its money tied up in these mortgages for years and years and years. And it wouldn't be able to really serve the community by making loans to people who need them in terms of buying houses. So what happens is we have this bundler, shadow bank, or could be a bank, could be a standard bank, but often what we call a shadow bank. And so what happens is the bundler buys these mortgages from the bank and gives the bank fresh cash, what I call fresh cash, to be able to make more loans. And remember, banks, when they make loans, they collect a whole bunch of fees, and so they're anxious to do that, and they just keep rolling this over. They're going to get more cash, they're going to get more mortgages, they're going to sell the mortgages to the bundler. So let's just look at one transaction. The mortgages go off the books, the bank gets cash in place of it, and now here's the mortgages on the bundler's asset side of its balance sheet. But remember, it's got to pay for them somehow. It's got to finance them. So how does it finance it? Well, it issues asset-backed commercial paper. And so that asset-backed commercial paper, very short-term commercial paper, very short-term lending, and it's backed by mortgages, asset-backed commercial paper. So it takes a little while for the bundler to process the thousands of mortgages it buys, but eventually it packages them and sells them in the forms of bonds, mortgage-backed security bonds. And so it transforms them into mortgage-backed securities, and eventually it sells them. I mean, it doesn't take that long, especially in today's world with computers, to be able to buy the mortgages, turn them into mortgage-backed securities, and now translate that into cash. And once the mortgage bundler gets the cash, it pays off the commercial paper and starts all over again. What I left out of the story was there's obviously margins going all through this, so that the bundler makes money and the bank makes money. But that's just an unnecessary complication. What we want to see is, here's the transactions and the process and how it works. Oh, and by the way, this is called securitization. And sometimes it's referred to as the originate to securitize model. It's a term you're going to hear a little later on in Dodd-Frank. The model is sometimes called originate to securitize. So banks intentionally originate mortgages knowing they're going to sell them to a bundler and knowing that the bundler will securitize them. So the model as a whole between the bundler and the bank is called the originate to securitize model. And it's an economically sound model provided it's done properly, and that's what Dodd-Frank attempts to do, is to regulate it so it's done properly. Now let's move back to the slides. Now keep in mind, just to make sure we have the terminology right here, that when you have securitization, you have mortgage-backed securities. There's just securities, bonds, that are backed by mortgages. And then you also have what's called collateralized mortgage obligations. For our purposes, they're basically the same thing. They're bonds sold with ultimately real estate as the collateral behind those bonds. So when you have a mortgage-backed security, the mortgage-backed security is backed by mortgages, and the mortgages are backed by the collateral of the housing, the real estate. And by the way, you can do securitization for student loans, credit card loans, and other types of loans, and they're basically referred to generically as asset-backed securities, or what's often called as pass-through securities, because the cash flow that comes off the loans ultimately goes to bondholders, and it's interest payments and principal that are going back to the bondholders. And so what's interesting now is that the financial markets became more sophisticated and more leveraged. And what I mean by that is mortgage-backed securities and collateralized mortgage obligations became collateral themselves for borrowing. So over the years leading up to the Great Recession, lots of financial institutions bought pass-through securities, mortgage-backed securities, and they used those mortgage-backed securities as collateral for them to borrow and finance their day-to-day operations. So you have a loan, it's backed by mortgage-backed securities, and the mortgage-backed securities are backed by mortgages, and then the mortgages are backed by real estate, ultimately, the value of real estate. Now let's bring in the credit rating agencies into this big picture that I'm drawing. In order for mortgage-backed securities to be purchased by mutual funds and other financial institutions, there should be a credit rating associated with that. What is the possibility of default on these things? That's what a credit rating does. And credit rating agencies evaluate the various mortgage-backed securities that were being issued. Keep in mind that mutual funds, including money market mutual funds, they can't buy bonds that don't have a credit rating. They're required to buy bonds with specific credit ratings to reduce the risk to investors in those mutual funds and those money market funds. And so without that credit rating, the demand for the bond, the mortgage-backed securities, would be really low. And not only that, it would force the bond to pay a higher coupon. So the issuer would have to pay a higher interest rate if the bond didn't have a decent credit rating. It turned out that during this process of securitization and the real estate market boom that was going on is that the credit rating agencies gave very high credit ratings to mortgage-backed securities. They often gave them investment grade ratings, even for subprime mortgage-backed securities, which was quite interesting. In fact, Congress was very interested in that very question. How could these credit rating agencies assign an investment grade to mortgage-backed securities on subprime loans? And those subprime loans ultimately defaulted, and the mortgage-backed securities ultimately defaulted. And that caused chaos in the financial markets. So you can see why the financial markets were spooked when there was a lot of investment-grade bonds defaulting. So as soon as you have a real estate bubble pop, and there's unemployment going up, interest rates are going up, and people are defaulting on their loans, especially in the subprime area, then the loans go bad, the mortgage-backed securities go bad, and then the financial institutions that bought those mortgage-backed securities are going bad. So you see that chain reaction. The funny thing is, a lot of organizations, mutual funds and other companies bought that asset-backed commercial paper. They didn't even know it was asset-backed commercial paper. They were surprised that they bought asset-backed commercial paper. And so what happened in the financial markets at this point was there was total confusion. There was commercial paper that was unsecured, issued by household names. There was some commercial paper that was issued by non-financial institutions or non-banks who were not household names, and it was asset-backed. That asset-backed securities became tainted, but a lot of people just didn't know what was going on with the commercial paper that they had purchased, so they just steered completely away from the commercial paper market. The collapse of the commercial paper market was ground zero for the liquidity crisis component of the Great Recession. So here you can see the commercial paper market. Look at it taking off before the Great Recession, and then it crashing down in a couple of years drops significantly below where it started in 2004. And it trickles along, and now it's come back down again. Even in the coronavirus, it's coming back down as various companies start to deleverage. They stop borrowing. So now, because of the liquidity crisis, liquidity started to dry up, and we had increases in foreclosures, mortgage delinquencies going up. It caused alarm in the credit markets, and the credit markets ultimately stopped working. So then the question becomes, okay, we have a liquidity crisis. How could that impact the rest of the economy? Well, look what was going on. There was higher interest rates. That affects the overall economy. Heightened risk aversion. That slows economic activity across the board significantly. There was a fear of unknown, caused financial panic. Companies completely unrelated to the real estate and pass-through markets had a difficult time borrowing. And the credit crunch ensued, and it got even worse. Now let's look at the credit default swap market. This was going on big time during the Great Recession and before, well, especially before the Great Recession. Now let me back up and explain what a credit default swap is. A credit default swap, I guess, could best be explained by comparing it to life insurance. So when you buy life insurance, you're buying insurance on an individual that you have a valid insurable interest, such as a financial interest, where you would be adversely affected by the person's death. Credit default swaps are like an insurance policy, but they're an insurance policy on a credit situation of a company, a credit rating of a company. So with a credit default swap, when you buy one, you're paying a premium periodically, just like a life insurance contract. And the payoff is going to happen if there's a credit event for the particular company you bought the credit default swap on. So what's a credit event? Well, it could be default on the company's bonds. It could even be a downgrading of the bonds credit rating. So you got to read carefully the contract that comes with the credit default swap to make sure you know exactly what the credit event will be that triggers a payoff and how much the payoff will be. Now, what's interesting about a credit default swap is you don't have to have any connection to the company in which you bought the credit default swap on. So you can be company A and buy a credit default swap on company B. So you say, well, that doesn't sound too bad. But what if company A, after they buy the credit default swap and publicly badmouths company B to the point where the creditors to that company B want to pull out and they want to pull away from the company because they're getting scared and they're getting nervous that the company may collapse. Rumors, basically. And so a company A could buy a credit default swap on company B, cause a downgrade, eventually cause the company to become unstable, a potential downgrade, and then the credit default swap would be triggered and company A would make a payoff, completely independent of company B, other than the credit default swap. That's what happened in the credit default swap market before the Great Recession. There were companies that were selling trillions of dollars worth of credit default swaps on financial institutions in the Wall Street area, thinking that, hey, these financial institutions can never go under. The market's too strong. There was no risk aversion. People had no fear. And so they were selling these credit default swaps, collecting the premiums. So they were financial institutions selling these swaps, collecting millions in premiums with notional value of those swaps, those contracts, in the trillions of dollars. Well, what happened in the Great Recession? The worst possible event happened. Credit events, downgrading, triggered a whole bunch of credit default swaps. Even companies that had no credit problems were badmouthed and rumored to have problems, and those rumors actually caused problems for these stable companies, which just further compounded the financial crisis that occurred in the Wall Street area. So, what is that an example of? It's an example of a moral hazard. You buy the credit default swap, you start paying the premiums, and then after the fact, after you bought the contract, you do something that's highly risky, that causes an event That causes a loss for the insurance company, the company that sold the credit default swap, and you end up making out from it. That's another example of a moral hazard situation. Now, let's go back to the financial institution that sold too many credit default swaps. Well, if you sold trillions of dollars worth of credit default swaps, you can't pay them all back. You can't pay off those credit default swaps because you overextended yourself. It's like the example I've given before, that it's basically a homeowner's insurance company that only insures Florida, and a hurricane going right up the middle of Florida and wiping it all out all at once. The insurance company obviously was overextended, not diversified, and couldn't pay off. Well, the fact that the financial institutions that sold those credit default swaps couldn't pay off their commitments meant that they were going bankrupt also. So the insurance companies, which were financial institutions here, selling the credit default swaps, approached bankruptcy themselves. As a result of this, many companies, including the gigantic AIG company, AIG stands for American International Group, it sold traditional insurance, but it also got involved in the credit default swap market, and that caused it eventually to go under, or about to go. I shouldn't say it went under. It was about to go under, but it was so huge, it was too big to fail. So the regulators, such as the Fed and the Treasury, decided that AIG could not fail, because if AIG failed, it had assets measured in trillions, and that if it went under, it would drag all of the other financial institutions down. So what happened was the Treasury took over AIG and took control of it. So if you read the literature on these bailouts, the credit default swaps, and the taking over of AIG, and the Treasury and the Fed taking over numerous banks, you'll find all sorts of information. It's very hard to reconcile. Let's just say that the Treasury committed billions of dollars to stabilize AIG, billions of dollars to stabilize banks that were very big, and it also included, traditional firms that were unrelated to the financial markets, like General Motors, because General Motors was considered too big to fail. Now, fast forward a few years, U.S. News reports, and many other organizations reported numbers like these, but the numbers are all over the map. It says, still, one thing that seems clear is that taxpayers came out ahead. Interesting. In total, $623 billion in taxpayer money was dispersed via bailouts, and roughly $698 billion has come back via dividend revenue, interest fees, and asset sales. Asset sales correspond to the government taking equity positions in various firms, common stock, and then selling that common stock later on at a significant profit. It doesn't take a math genius to see that the bailouts ultimately earned taxpayers more than $75 billion in profit, and the number is still growing as time goes on. So my point is here, it was a disaster at the time. Nobody knew what was going to happen in the future. The government took over a lot of assets of a lot of companies and ended up buying them real cheap and selling them years later for a substantial profit. So it all worked out, but still, nobody wants to go through that again. And that's where the Dodd-Frank Act comes into play. The Dodd-Frank Act is going to address almost all of the situations I've described in this video so far. So this lays the groundwork for the Dodd-Frank Act. So like I said earlier at the beginning of this video, you can't really understand the Dodd-Frank Act until you see what unfolded during the Great Recession and what led up to the Great Recession. Now that we have a handle on it, let's just spend a few minutes looking at what the Dodd-Frank Act requires and what it means for financial institutions. So let me give you a brief, or what I would call a textbook summary of the Dodd-Frank Act. It created the Financial Stability and Oversight Council, and what that means is, look, there was a lot of regulatory organizations, and there still are a lot of regulatory organizations that oversee financial institutions and the markets they serve. The problem with that situation was there was no umbrella organization that oversaw the entire process of regulation. So while there were tons of regulatory overlap, there was also a lot of regulatory holes in the system that weren't covered by any one single regulatory body. So the Dodd-Frank Act recognized that and created this institution called the Financial Stability Oversight Council, which oversaw the regulations of all the regulatory bodies, such as the Securities Exchange Commission, the Federal Reserve, the Commodity Futures Trading Commission, and so on, and was also responsible for looking out for the next financial disaster. That's right, this council was tasked with spotting or anticipating the next financial crisis. The Dodd-Frank Act also created the Consumer Financial Protection Bureau, which regulates businesses with over $10 billion in assets that issue residential mortgages to try to prevent those abuses that we saw in subprime lending. It also limits the Dodd-Frank Act also limits Federal Reserve lending. In other words, the bailouts that it did in the Great Recession. Congress was upset over the fact that taxpayer money was used to bail out financial institutions that took heavy risks that were viewed upon by some to be basically gambling at taxpayers' expense. The Dodd-Frank Act also implemented heavy systemic regulation, including identifying SIFIs. SIFIs are systematically important financial institutions. Basically, institutions that are too big to fail. That's what a SIFI is. In addition, the Dodd-Frank Act also imposed higher capital requirements, especially for banks that are big, and big banks must undergo annual stress tests, and those stress tests are designed to run scenarios of financial crises and to see how the bank would respond. So, for example, it might run a test of, what happened if interest rates spiked, the interest rates fell, what happened if the stock market fell 20%, and other scenarios such as, what happens if your default rate on your securities, on various securities, go up by 5%, or whether the bank could withstand an extreme liquidity squeeze or the drawdown of significant lines of credit from its customers. Or, of course, does the bank have sufficient capital to withstand a certain percentage of loan losses? The Dodd-Frank Act also addressed resolution authority, and resolution authority basically deals with how do you unwind failed banks, failed bank holding companies, and large financial institutions. It was a problem during the Great Recession. What happened was during the Great Recession, probably if you talk to people on Wall Street, the scariest part of the entire Great Recession was when Lehman Brothers, a large financial institution, collapsed and was not bailed out by the government. That spooked the market more than anything else during that crisis. The reason that the regulatory authorities point to for not saving Lehman Brothers and bailing it out was they didn't have the ability to do it. Specifically, the FDIC did not have authority over bank holding companies, and the Federal Reserve didn't have the ability to deal with and resolving failures of bank holding companies and other large financial institutions. So this resolution authority gave regulators the ability, namely the FDIC, the ability to unwind failed banks, bank holding companies, and large financial institutions. The Dodd-Frank also imposed regulations on derivatives such as credit default swaps, and the Volcker Rule was imposed. We haven't talked too much about the Volcker Rule in the past. The Volcker Rule is named after Paul Volcker. He was a Fed chairman in the early 1980s when we had really high inflation. He's credited with breaking the back of super high inflation, bringing it down. He developed a rule. He sought a rule to limit proprietary trading. In other words, proprietary trading is where you have a financial institution, let's assume it's a bank or a bank holding company, that has and exposes its own capital to trading risks. In other words, the bank or bank holding company is speculating and trading securities using its capital. Well, what's the problem with that? Well, the problem with that is if the bank fails because of that, basically taxpayers through the FDIC and the federal government are going to be responsible for the bailout and bear the ultimate costs of that speculation. So the Volcker rules set the limit proprietary trading of securities and derivatives by banks. Now let's go beyond what we often see in textbooks. So the full title of the act is the Dodd-Frank Wall Street Reform and Consumer Protection Act. So right away you can see some political backlash. Congress is angry with Wall Street, so this is Wall Street reform. And Congress is also looking to protect consumers. And so that's why the act is named as it is. Now you can find this act on congress.gov. It's 849 pages long, and that's just the act. So what do I mean by just the act? Well, the act itself is 849 pages, but it delegates much of its implementation to various agencies and regulatory authorities. And it requires and asks of many studies to be performed, and those studies and the other regulations run into thousands of pages. Not only that, but there's been many amendments to the Dodd-Frank Act, and various parts have been repealed, amended, and changed over the years. And even as late as the summer of 2020, the Volcker rule has been changed to soften the negative effects on bank profitability, or so the banks claim. So which regulators were mandated to implement the various rules imposed by Dodd-Frank? Well, let me show you. Here's just an example of some of it. Obviously, the Federal Reserve, the Securities and Exchange Commission, the FCTC, the Commodities Futures Trading Commission, because they deal with credit default swaps. The Office of Comptroller of Currency, remember that organization that was started back around the Civil War time to have one currency? And then the SIPC, which we don't really talk about too much in this course, and that's the Securities Investors Protection Corp, and obviously many others. The list goes on, and you can find that in the Act itself. So right up on page 1 of the Dodd-Frank Act, it says, look, this is an act to promote the financial stability of the United States by improving accountability and transparency in the financial system, to end too big to fail, to protect the American taxpayer by ending bailouts, to protect consumers from abusive financial service practices, especially around the subprime lending area, and for other purposes. Here's just a list, and I don't want you to memorize this, of some of the various sections. There's lots and lots of subsections within the Dodd-Frank. And so right off the bat, you see early on, section 111, Financial Stability Oversight Council is established, and it goes into how it's establishing it. Then in a later section, it talks about how there's the Office of Financial Research is established, and then how systematic risk is determined and defined, and what it means for an orderly liquidation of covered financial institutions. In other words, how do you resolve and unwind companies that are failing? And it goes on, and then it's even a part here towards the end here, regulation of the swap markets and derivative clearing organizations. Now we're in a better position to understand what Dodd-Frank is talking about when it mentions derivatives clearing organizations. So let me elaborate. There were several important problems that needed to be resolved in the credit default swap market, as we discussed. Recall that credit default swaps are bond insurance on companies. It was noted that leading up to the Great Recession, companies with, say, $10 billion in value had many times more value in credit default swaps that were traded and outstanding. In other words, market participants were not just hedging their bets on their actual investments in the bonds, which is what credit default swap insurance does. It basically provides insurance for the bonds you buy. But when you see a company has way more credit default swaps outstanding than it has value, that means market participants are speculating on the company, speculating using credit default swaps. That speculation, if significant enough, could be very destabilizing to the economy, especially when things head south. These credit default swaps, before the Great Recession, were traded on the over-the-counter market, which had no way of centrally clearing, in other words, no way of centrally keeping track of all the contracts that were outstanding. So basically, we had trillions of dollars of credit default swaps that were traded in the market, but nobody knew the full extent of it because there was no central place where all the transactions were processed. They were processed through individual transactions in the over-the-counter market. And so in order to reduce the instability that credit default swaps can cause on the financial markets, Dodd-Frank required that there be clearinghouses for credit default swaps. In other words, all credit default swap transactions that are executed needed to be cleared. That means processed. So clearing is the process of keeping track of individual securities and the money that changes hands and the margin requirements behind them. So Dodd-Frank required these credit default swap clearing organizations so that we could have a handle on the amount of systemic risk that they're causing in the financial markets. So now we have a clue to the extent of which there's speculation going on in our financial markets through these clearing organizations. So now let's move on to Section 939. Recall that the credit rating agencies had a hand in the cause of the Great Recession because they gave very high credit ratings, like investment grade ratings, to mortgage-backed securities, ratings that were obviously inflated. Congress was infuriated with the conflicts of interest surrounding the credit rating agencies that led to high and unsubstantiated credit ratings, and as a result, it removed any references in the regs to the agencies and their credit rating system, effectively delegitimizing the credit rating agencies. Now, what's interesting about the Dodd-Frank Act is that it recognizes the economic value of the originate to securitize model. You know, the model where banks originate mortgages, they sell them to a bundler, and the bundler securitizes them and eventually sells them as bonds. That's what's sometimes referred to as the originate to securitize model. Recall, that model represents a conduit for cash to get to a bank to be able to originate mortgages. So remember why securitization was started in the first place. It was started in the first place because banks were sitting on 30-year mortgages for a very long time. And basically what that means is their money is tied up in mortgages for 30 years in some cases. And securitization allows the bank to sell those mortgages, get fresh cash to be able to originate more mortgages to facilitate the housing market. The government and Congress are very interested in keeping the housing market strong. And it also allows for a lower interest rate. So if you can get a large supply of cash into the bank to originate mortgages, it means the price, in other words, the interest rate associated with the mortgage will be lower. So the originate to securitize model is seen as being one of the greatest innovations in finance of all time. So what does Dodd-Frank have to say about it? Well, let's look at Section 941. 941 says the Commission, the SEC, shall jointly prescribe regulations to require any securitizer, basically a bundler, to retain an economic interest in a portion of the credit risk for any asset that the securitizer, through the issuance of an asset-backed security, transfers, sells, or conveys to a third party. And furthermore, the regulations prescribed under subsection B shall prohibit a securitizer from directly or indirectly hedging or otherwise transferring the credit risk that the securitizer is required to retain with respect to an asset. And it goes on even further to require a securitizer to retain not less than 5% of the credit risk for any asset. So what that means is, as a bundler, you just can't securitize securities, sell them, all of them, 100% of the mortgages you buy, package them, sell them as bonds, and wait to buy the next batch of mortgages to securitize them and sell them. You have to retain 5% or more of the credit risk of those securities. Now that doesn't sound like very much, but remember what a bundler does. A bundler is involved in high turnover. It buys mortgages, turns around, and then in less than a few months sells them as bonds. It relies on high turnover. So 5% may not seem like very much, but when you have a significant amount of turnover, 5% compounds up to be a very large amount. So what it basically does is it requires bundlers to have some skin in the game that they didn't have previously. So, one of the greatest financial engineering innovations of all time was subject to moral hazard because the securitizer did not bear the full consequences or responsibility of their actions. They could buy ninja mortgages. Remember, ninja mortgages are no income, no job, and no assets. Or low to no documentation mortgages, ones that were extremely risky, and sell them to bondholders with an investment grade credit rating. Wow, what a scheme that was going on. So it looks like Dodd-Frank did something good here. And with just the right amount of regulations, at least in this area, was able to fix a model that was broken. So there you have it, an overview of the Dodd-Frank Act from a high level. The Act seems to have addressed many of the causes and issues surrounding the Great Recession. For example, many people in the mortgage business, banks and bundlers, would agree that the Act has stopped a lot of reckless behavior. But at the same time, they tell you that the additional regs are onerous. Since Dodd-Frank was enacted, I've had conversations with people in the mortgage business, people who worked in the field before and after the Great Recession. They'll tell you that the industry was insanely out of control prior to the Great Recession and that the environment now is sane. However, the mortgage business is now way more complicated and the administrative costs are high. The costs are considered by many to be fixed costs and are especially burdensome to small banks. So, was the Dodd-Frank Act just the right amount of regulation to fix the originate to securitize model? Well, in my mind, the story is not over. So you probably can tell from my coverage of regulation that I'm not a big fan of it, at least not the kind we see in the United States with the overlapping regs and the overlapping regulators. History indicates that the law of unintended consequences is always just around the corner. I'm thinking of geographic restrictions, which force banks not to diversify, and I'm thinking of interest rate ceilings that strangled banks in need of deposits, things that we saw, topics we covered under regulation in this course. Those regs were well intended and they were imposed in the 1930s, but decades later, they nearly destroyed the banking industry and no doubt lowered the trend of economic growth. So my question to you is this: what problems, if any, do you think the Dodd-Frank Act will cause in the distant future?